Well, g'day there, everybody. Thanks a lot for joining me as at this Thursday afternoon market recap. I hope you are doing well. Just a quick comment on the state of the markets as at the close on Thursday. We were left with a relatively interesting candlestick today. What is more interesting, however, is where this lower wick is showing up. In order to show you this, what I'll do is I'll come over to the right-hand corner of my screen. I'll bring up this horizontal line and I'm going to drag this down. I will delete this once this video has concluded. But if I take this line all the way down to the bottom of what now appears to be that of a hammer candlestick, I want you to focus your eyes over to the left-hand side of my screen. Essentially what we did today, if you pay attention to the L, which is the low of this candlestick, you can see it's coming in at 2,836, whereas the high, which is just to the left of the L, is 2,836 as well. And this is taking us back to the 29th of March, all right, the end of the first quarter of 2019. Why is this important? Well, essentially what has happened is that since we have come on up here, produced a slightly high on the S&P 500, we have been in, albeit at the moment anyway, that of a temporary or very slight sort of market correction. We have seen this market again bounce off from, of course, the Christmas lows very, very resiliently. We haven't really seen all that much of a correction. We've moved over 20% within the first 4 months of 2019. It has been an absolutely mammoth move. So this correction, or what appears to be that of a retracement, is very much so welcomed as per the general sort of movements that you would expect to see in financial markets. It would be great if everything went up in a linear straight line. However, that is not the reality that we operate in as technical traders and also institutional or global investors looking at markets not only in the United States but also around the world. Now, again, going back into this, and why is this significant, is because, again, the resilience or the theme of resilience is very much so still permeating through the current chart. This lower wick here and how it has come on and tagged to the decimal point almost this particular candlestick, which essentially set off that original gap, all right, for the first trading session of April. It has now been definitively closed on the S&P 500. Once we came on down and tagged to the point, we began to see a reaction off from these lows. And as you can see, we actually traded up during the session. Not only did we move back above where we opened, which was originally a gap down, we actually closed above it. And we really only closed down, right, just over 8 points on the daily movement. However, we were down considerably more during some of those intra-session lows that we, double sort of touched during today's session on Thursday. This is very important. It is a big clue as to the state of the markets and, again, the resilience of dip buyers to continue showing up. And what they are doing is, again, accumulating positions at strategic locations. Whether or not this plays out tomorrow, whether or not it plays out next week, it's largely irrelevant. What this is telling you is that people are still prepared, again, to jump on into this market, and they're looking at this retracement that we find ourselves in now for about 2 weeks as another opportunity, all right, to accumulate positions prior to ultimately the breakout above the swing highs, taking us back to 2,950. Now, I know 2 days ago, we very quickly drew a Fibonacci retracement on this chart. The problem is generally when you talk about Fibonacci ratios, or at least support and resistance lines, you want to have multiple ranges and to ultimately find confluence of essentially support in this type of scenario anyway that we're looking at. And what I mean by that is generally you don't stop with one Fibonacci line. On my screen at the moment, we've got one range, okay? The range begins down at the December 26th low, or leading into the 26th low. And then, of course, the peak up here. The range here is only one. There's only one Fibonacci retracement. The problem is that this retracement so far is so shallow. If we were to try and find levels of confluence, again, being that of support of multiple sort of ranges, again, I'm just sort of hypothetically drawing range number 2. This technically would be range number 2 from, of course, the all-time high most recently. What you're getting is that the retracement that we currently find ourselves in and where we are currently priced, it really doesn't even come down. I mean, it tagged it today as to where the second range would begin. So essentially it makes the confluence null and void. Yes, I have picked up on the fact that we do have 2 areas of confluence of differing ranges, okay? Range number 1 and range number 2 that I've just drawn. And that is coming in at a roughly 2,655, all the way down here. So you can see these 2 levels, all right? The problem is we are nowhere near these levels, and we have no indication, as at the close on Thursday, that we are actually going to break below the current level and move and head on down to this current area. I'd be somewhat surprised so to speak, if we did see a move like this, what's more important again at the current juncture, if I can just take off this second range that I've just drawn because it just makes my my chart very sort of convoluted with a bunch of lines everywhere, is that we have seen this reaction off from this open window. And in fact, if you go back to the original analysis that we were talking about back in the month of April, we were actually talking about, well, it would actually be healthy for the market to ultimately close this gap after the gap and go. And that's exactly what we have done as at Thursday. So I just wanted to point that out there. Obviously, at the moment, with that trailing 50-day exponential moving average, we do have another hammer candlestick right on that area of support. And as you can see in retrospect now, we have actually bounced off it. All right. So again, whether or not you want to call it the gap fill and the bounce off from that closing gap, or whether or not you just want to call it simply the respecting of that rising 50 EMA on the S&P 500, together it's starting to paint a picture of a reliable support area, although it is, of course, very much so early days at the moment. All right, I just wanted to point that out to you. Now, again, on the Dow Jones Industrial Average, we've closed both of these gaps, again, going back to the similar time frame back in the last trading session of March, the first trading session of April. We closed that a couple of days ago, but now that we have this lower wick again, any other gaps around this area, or at least just a general retest of this past support area in the month of March, it has been done. Yes, we have overshot the 50. We don't have that white candlestick like you just saw on the S&P 500 on the Dow Jones Industrial Average. But of these two markets, I would be, again, paying more attention to what the S&P does at and around these critical sort of support areas and past open windows that are now essentially filling during this correction. As it stands, if I bring up the oscillators again, we are short-term moving into oversold territory on the RSI. The Stokes still has a distance to go. It doesn't necessarily need to get down into oversold, but we can stabilize around the 50 point. The MACD, this is good. Although it is technically bearish, we are essentially resetting and allowing, of course, these oscillators to take a breather, to reset. And if I continue again, the CCI is still below the 100. So again, it's not poised for that immediate breakout yet. The ADX is turned up on the sell-off. But again, a lot of what this is has to do is simply allowing these oscillators to reset out of overextended and very much so overbought conditions that we have been in really for the entirety of 2019. That's the big sort of narrative of this market at the moment. This is nothing more than a general correction, a very much sort of overdue correction. And again, you should be welcoming this with open arms as another buying opportunity or from strategic locations that I just pointed out to you, especially on the S&P 500. So it makes a lot of sense. Again, even if it immediately doesn't play out, we're still looking at these equity markets taking out the all-time highs. All right, and then continuing to trend further into 2019. And the final market, not the S&P 500, but the Nasdaq. I just wanted to point out to you, although we do have a similar type of candlestick. First of all, we have a dark candle. So what that means is that we obviously closed below where the candlestick opened. We did sell on off down intra-session, and much like the S&P 500, we did see again dip buyers show up to begin buying the market and sort of pricing it off from the intra-session lows. The problem is, however, if I use that same horizontal line and if I drag it down to where this gap essentially opens on the final trading session in the month of March, we still have a little bit further to go. So if you pay attention to the L on this candlestick, you can see that the low was 7,796, whereas this line here is 7,734. So we still have, a little bit further that the Nasdaq could really sell off into before, again, we have a strategic location as to where we can say, look, definitively this gap has closed and, this may be a buying opportunity. Now, I understand that even if you look back more so retrospectively, you can see one other gap all the way down here at 7,425. At this point in time, we're not looking at this to be a definitive target. This is more so a critical support area down here, again at 7,734. But again, we don't just simply look at gaps and say, well, this is, or depending, of course, on the circumstance, the direction of the gap, whether or not we're looking for a correction or that of an upward move, all right? The upward type of gaps, or at least closing past higher gaps anyway, that acts more so like a magnet other than or contrary to this type of gap in this sort of macro environment that we find ourselves in, whereas the bull market is still intact. So I just wanted to point that out as well. This is a critical area on the Nasdaq, but more so, you should be paying attention to, of course, what is happening on the S&P 500 at this current time. So I just wanted to point that out to you. Pay attention to the oscillators again. You can see on the Nasdaq, they are still technically resetting. We're very much so short term, starting to push into oversold territory as per the RSI. But what is good about this again is that we are allowing the MACD to shake out, and at the same time, we're still not doing any technical damage. We're still firmly above the longer term simple moving averages on all of these markets. And as such, again, this is a natural correction, which I don't think the Fibonacci is really going to give traders all that much help at this current time. Okay, and we're just looking at this to ultimately base, potentially still to produce that of another subsequent higher low prior to the continuation of this market moving higher. All right, so pay attention to that 50, and we'll recap it as that pro. We'll go into more detail with some of these Fibonacci levels on Saturday, and also a more in-depth sort of market analysis as well. But it's important to actually point this out to you because there are people, all right, intelligent traders and probably institutional traders and investors who are beginning to buy off from the closure now of this window, taking us back to the final session, or the beginning, right, of the final session in the month of March 2019. All right, so on that note, everyone, I'm going to say farewell. If you have any questions, email me, success@pivotpointtrading.com. Until next time, be safe, be well, and I'll be back in due course. All the best. Goodbye.